Welcome to This Explainer. Look, if you've been feeling a bit of economic anxiety lately, maybe you're watching persistent inflation just eat away at your purchasing power, or you're stressing about future stability, well, you are absolutely in the right place. Today, we're going to cut through all that noise to build a structured, actionable roadmap to long-term wealth using ETFs.
Okay, let's dive into this. Here is our agenda for today. First, overcoming investor overwhelm. Then, unpacking the ETF basket, followed by why ETFs are so popular, choosing your ETF type, and finally, 6 steps to start investing. I promise this path will take us straight from confusion to absolute clarity.
Section 1. Overcoming Investor Overwhelm, also known as the stock market dilemma.
You know, stepping into the modern economy is, well, it's pretty intimidating, right? Between rapid AI advances, fluctuating interest rates, and all the geopolitical uncertainty out there, it's totally normal to feel completely paralyzed by one simple question: where do I even start? With thousands of individual stocks to choose from, the sheer anxiety of trying to pick the perfect one keeps way too many people just sitting on the sidelines.
It really boils down to a choice of strategy. On one hand, you can try to pick a single winning stock, but honestly, that's a massive risk. If that one company underperforms, you take the full hit. On the other hand, you can choose to own a piece of the entire market. This gives you built-in safety, allowing you to capture the overall economic growth rather than betting absolutely everything on one single CEO's decisions.
Moving right along to Section 2. Unpacking the ETF basket and answering the question, what exactly is an ETF?
So how do we actually pull off owning the whole market? Well, we use an exchange-traded fund, or ETF. It's the financial expert's favorite tool for modern wealth building. Simply put, it's a single investment fund that owns many different assets, yet it trades on stock exchanges exactly like an individual stock would during normal market hours. It's straightforward, it's highly liquid, and it's incredibly accessible.
And this brilliantly illustrates the core concept. Think of it as a basket. Instead of buying one single apple, or, one single share of a company, you're buying a prepackaged grocery basket containing a little bit of everything. With just one single purchase, you automatically own a tiny fraction of Apple, Microsoft, Amazon, Tesla, and hundreds of others.
To put that into perspective, let's look at the power of this using the number 500. Buying an S&P 500 ETF means you instantly hold shares in the 500 largest U.S. companies. That drastically reduces your risk, because even if a few companies have a terrible year, the really strong performers offset those losses. You are beautifully insulated by sheer volume.
Which brings us to Section 3. Why ETFs are so popular. It really is the smart investor's choice.
I mean, over the past decade, literal trillions of dollars have flowed into ETFs globally. It's built on 4 absolutely crucial pillars that protect your wallet: diversification across multiple industries, lower costs, simplicity that completely removes the agony of stock picking, and liquidity, giving you the flexibility to trade whenever the markets are open.
Now, what's really interesting about this slide is the staggering difference in costs. While actively managed mutual funds often charge fees exceeding 1%, broad market ETFs charge a tiny fraction of that. In investing, keeping those costs low means more of your money actually remains invested to compound and grow. Over 20 years, those saved fees can easily equal tens of thousands of dollars staying right in your pocket.
Okay, Section 4. Choosing your ETF type, or navigating the landscape. To confidently navigate all this, you really need to know your tools. Think of it like a menu. Broad market ETFs track entire markets, providing instant diversification for beginners. Sector ETFs target specific industries if you want specialized growth like AI or healthcare. Bond ETFs offer lower volatility government or corporate bonds. International ETFs provide geographic safety. And dividend ETFs, they focus on companies that regularly pay out profits, which is absolutely ideal if you're looking for passive income.
Let's move to and see how this builds into Section 5. 6 steps to start investing. This is your actionable, chronological blueprint.
But wait, before we look at the actual execution steps, we absolutely have to talk about this number: 20%. Listen, if you're carrying high-interest credit card debt at around 20%, hear this clearly. That interest rate will destroy your wealth way faster than any stock market can ever build it. Eliminating that toxic debt is a strict, non-negotiable prerequisite to investing.
All right, so here is your exact blueprint. Step 1, define your goal. Step 2, build a 3 to 6 month emergency fund first, so you never have to panic sell. Step 3, pay off that high interest debt we just talked about.
Step 4, choose a reliable, low-fee online brokerage. Step 5, start simple with broad market ETFs. And Step 6, invest consistently.
So, the crucial point is that consistency is often way more important than timing. Beginners almost always freeze up waiting for that perfect moment to jump in. Actually, scratch that. A lot of seasoned folks do it too. But forget timing the market. Use dollar-cost averaging instead. Just invest a set amount every single month. This mathematically smooths out that short-term market anxiety, because you automatically buy more shares when prices are low and fewer when they're high.
Because ultimately, building wealth is not about chasing the hottest meme stock or letting emotions dictate your strategy. As our source material beautifully highlights, patience and consistency remain the true foundations of lasting wealth. It's about long-term thinking, weathering the volatility without panicking, and reinvesting your dividends to unlock the absolute magic of compound growth.
So that leaves us with one final, pretty provocative question as we wrap up this explainer. Will you chase trends or choose consistency? The tools are right here in front of you. Broad market ETFs give you the diversification, the low costs, and the simplicity you need to take control of your financial future. Now, it's entirely up to you to stick to the blueprint.